It wasn't that long ago that financial markets were this symphony of pure chaos, people shouting, frantic hand signals, phones ringing off the hook. But today, it's silent. That human noise has been totally replaced by the quiet, electric hum of servers executing millions of trades in literally the blink of an eye. So today, we're going to peel back the curtain on this silent revolution and really try to understand the code that now runs our entire financial world.
And that really gets to the heart of it, doesn't it? Every single time you buy a stock or make an investment, are you actually competing against an invisible opponent? An opponent that's faster, that's way more disciplined and can process more information in 1 second than you could in a whole lifetime?
And wow, this slide just nails the difference. On the left, you've got the past, a floor just packed with people driven by gut feelings and shouting. And on the right, you see the present, a cold, quiet data center, driven by pure logic and light-speed calculations. The game hasn't just changed a little bit, the entire arena is fundamentally different.
All right, so let's dive into this new trading floor, where the real heavy hitters aren't people anymore, but lines of code running on machines cooled to the absolute perfect temperature. Which, of course, begs the question. If it's not people in those brightly colored jackets, then who, or maybe what, is actually behind these billions and billions of trades? It's time to meet the architects.
Okay, so what are we even talking about here? At its most basic, algorithmic trading is just using computer programs to automate trading. These programs follow a predefined set of rules, that's the algorithm, to execute orders without a human ever having to click a button.
But here's the thing, algorithm is a huge umbrella term. They're not all the same. First, you've got the speedsters. These are the high-frequency trading bots that make trades in microseconds to cash in on tiny price changes. Then you have the bargain hunters, the arbitrage algos. They sniff out price differences for the exact same thing in different markets and profit from that little gap. And finally, you have the analysts. These are the big-brain predictive algorithms that crunch unbelievable amounts of data to try and forecast where the market's headed next.
And this is where things get really wild. We've moved so far beyond simple if-this-then-that commands. Today's algorithms use artificial intelligence and machine learning. They don't just follow the rules, they learn. For instance, an AI might notice that every time a certain CEO tweets about their company, the stock's volatility spikes. So it adapts its strategy in real time to trade on that pattern, a pattern a human might totally miss.
And let's be crystal clear, this isn't some small-time operation. We are talking about a full-blown, high-stakes, billion-dollar arms race. Firms are spending absolute fortunes just to get an edge of a few microseconds. Why? Because in this world, a microsecond can be worth millions.
I mean, the sheer scale of the infrastructure behind this is just mind-boggling. You've got these enormous server farms built right next to stock exchanges just to shave milliseconds off the travel time of data. You've got private fiber optic cables being laid under entire oceans. And behind it all are these elite teams of quants, mathematicians, physicists, and coders who are the real masterminds of this new financial world.
But all this incredible power, well, it's a real double-edged sword. For all the amazing efficiency it creates, it also introduces a whole new and very potent set of dangers. So let's break down both sides of that sword.
And this table really lays it all out. On the one hand, these algorithms provide huge benefits. You get more liquidity, which just means it's easier to buy and sell stuff quickly, and you get faster execution for everybody. But on the other hand, you get the risk of these terrifying flash crashes, where all that liquidity can just evaporate in an instant, and it sparks a serious debate about the fairness and stability of the whole system.
So let's talk about that dark side for a minute. Because when machines that are operating at the speed of light go wrong, the consequences can be immediate and they can be absolutely devastating.
And look, this isn't some sci-fi fantasy. It's real. On May 6, 2010, the market had its infamous flash crash. In just a few minutes, a chain reaction of algorithmic selling wiped out nearly $1 trillion in market value before it all just mysteriously recovered. It was a massive warning sign of just how fragile this new automated system can be.
And that brings up this huge question of fairness, right? When a regular person like you or me places a trade, we're basically bringing a bicycle to a Formula One race. We're up against machines with such a gigantic advantage in speed and information that you have to wonder, what does a fair market even mean anymore?
So you can bet regulators all over the world are scrambling to keep up. But trying to police these algorithms is like trying to catch smoke in your hands. It's just this relentless, exhausting game of cat and mouse.
Here's the first massive problem. A lot of these algorithms are proprietary. They're black boxes.
Sometimes even the people who made them can't perfectly predict how they'll react in the wild. So how on earth can a regulator possibly oversee them?
And then you've got the blame game. If an algorithm goes rogue and triggers a market crash, who's legally on the hook? The firm that owns it? The programmer who wrote the code? The truth is, our legal system just hasn't caught up to the technology. But this is the nightmare scenario, the one that keeps regulators up at night. In our super-connected global market, what happens if a bunch of major algorithms, all learning from the same data, start making the same catastrophic decision at the exact same time? Could that trigger a global chain reaction that no one can stop? It's the doomsday scenario they are desperately trying to prevent.
Okay, so it's not the complete Wild West. Authorities have put some brakes on the system. You've got market-wide circuit breakers that just halt trading if things get too crazy. There are limits on how many orders you can place and then cancel, and there are stricter reporting rules. But for every new rule they make, you can be sure a dozen new algorithms are being designed to get around it.
So, after all that, you're probably asking, okay, great, but what does this actually mean for me? How do you survive and maybe even do well in this new automated arena?
All right, let's break it down. Think of it as your survival guide. Step 1. Awareness is your single greatest asset. Just knowing that you're playing against machines changes how you approach the game. Step 2. Don't try to beat them at what they're good at. You're never going to win on speed. Instead, focus on what machines can't do. They can't understand the long-term vision of a company or bet on human ingenuity. That is your edge. And step 3, adopt the tools. Use the AI-powered analytics that so many platforms offer now to help level the playing field.
Because at the end of the day, the goal here isn't to fight the machines. The future of successful investing is going to be a partnership. It's about combining our uniquely human intuition and judgment with the incredible data crunching power of these very same algorithms.
Which brings us right back to where we started. So, what's the verdict? Are these algorithms a menace to the markets, or are they an incredibly powerful tool for efficiency? And the honest answer is, they're both. They've built a financial world that's faster and more efficient, yes, but also one that's way more fragile and, potentially, far more unequal.
So the takeaway here isn't to be afraid of this technology, but to really try to understand it, because these lines of code, these invisible hands, they're not just a part of the market anymore. For better or for worse, they are the market, and they are already busy building the financial world of tomorrow.